Hey traders, this is Raghee and welcome to the Sunday Q&A show. If you have any questions, any symbols that you want me to take a look at, please let me know. Let me know maybe the time frame that you're looking at, maybe if you have a position in it. So feel free to put those questions in. Phone lines are open for your requests. It would be kind of cool if we had phones, but that's so old school. Well, let's go to school here. Here we have finally, and it's been a bit coming. The S&P has officially, and I'm looking at the S&P futures. So 6 p.m. Eastern, and we're getting the first indication of a gap down that was pretty well projected from Friday's close. If Friday tends to close heavy, we have an old saying in trading, don't fade Friday. So in the case of Friday, what that would mean is if the session closes, I'm talking the last 45 to 60 minutes, if we're still seeing price action pressing at lower lows in whatever it may be, as we're winding down for the day, that's usually a pretty good indication that come the Sunday open and into Monday, we'll have more selling pressure. That's exactly what we're getting. The S&P futures, which is what I look at, because the S&P futures is the 23-hour version of the S&P, unlike SPY or SPX. We have now hit that 20%, 49.33. Now, I'm not here to give long-term investing advice. I'm not here to give investing advice at all. I'm here to be transparent about what kind of positions I'm willing to put in my book. There has been actually no exception to this in recent memory. When we have a 20% pullback in the S&P with the longer term, so let's define what long-term means. Long-term to me means a minimum of 6 months. I'm going to be patient. I'm going to wait those 6 months, and I'm going to build a long position in the SPY, typically using shares. Yes, you can use options if you'd like, but keep this in mind. This is not a short-term trade. This is a minimum 6-month time horizon. So that means between now and the next 6 months, as long as the S&P does not tumble down through desired account risk levels. Now you can set those whatever you'd like. I'm typically going to be somewhere between 3 and 5%, usually closer to 3. If the next 6 months that does not happen, I will leave that position open for the next 6 months with a multiple year time horizon. So this is what I say. Again, this would be with the SPY, so I can't do anything with it this evening here on Sunday at 6. But what I'll do is I'll look out into, well, history. In the past, when there is a 20% pullback, and I then imagine myself hopping into the DeLorean and fast forwarding 12 to 18 months, am I going to regret building a position after at least a 20% pullback? Now, there are a couple other things that I can do at this 20% level. Think of the 20% as sort of ringing the dinner bell. Whatever it is that you're looking at, once it's pulled back 20%. Imagine it as ringing the dinner bell. If I'm looking at the weekly time frame, what I can do now is say, look, am I expecting a V bottom? V bottoms, those sharp reversals, are usually the work of the Federal Reserve, and that is not in the cards for this particular sell-off. This is not like 2019. This is not like 2020 when we're expecting the Federal Reserve to gallop in and abruptly shift monetary policy. Now, in this case, it wouldn't be a shift. It would be a resumption of the already active cutting cycle that's just in a potential, give or take, 4 to 6 month, give or take a month here or there, 5 to 6 month pause. It is widely anticipated that the Federal Reserve will act in June or July. All right, well, that's quite a few months from now. If I take a look at that weekly time frame where I'm getting one new candle every week, I can start to look at different patterns. Patterns might be an inside day. Patterns might be a minor low. I might even look at this indicator that we call the top tier dots. Imagine having, say, a 200 period exponential moving average on a weekly time frame, but instead of just a pure 200 EMA, you're looking at moving average crosses, a short EMA and a long EMA, and then factoring in participation. And if participation and those EMAs on cross, participation drops, EMAs on cross, those dots will disappear. When they're visible, that tells me there's a higher likelihood of those dots acting as support. That could be another target. If traders are saying, Rog, 49.33, forget about it. 20% at least, I'm going to start waiting for that minor low inside candle, or I might wait for 4,600. All I'm saying here is depending on your time horizon, whether you're looking for the next 6 minutes, 6 days, 6 weeks, 6 months, 6 years, the time frame that you're looking at is different and your time horizon is different. That's what I keep in mind. So if I'm looking at a weekly time frame, when it comes down like this, I view this as a sale. Is it pleasant? It depends on where you're long from. It depends on what opportunity looks like. And in the last, let's go back to 2008. In the last, since 2008 to 2020, so in the last 17 years, these types of drops have presented opportunities for traders with that longer term type time horizon. There's always an opportunity somewhere, right? So the next question is, Rog, but are you bearish? Oh gosh, if I'm looking at daily time frames, hourly time frames, and even 5-minute time frames on most of the symbols that I'm watching, from staples to communications to the S&P to tech, whatever, yeah, I'm not even allowed to buy. There might be brief periods of day trades that might give a little bit of bullishness or a little bit of bearishness. But once these red candles in the 1 hour and the daily time frame dominate, and 5 candles then becomes dominating, I'm not even allowed to buy calls. I'm not even allowed to be bullish. So with the red candles, yes, this is where I've got to look for the opportunity to short the rip. So instead of buy the dip, when markets move higher into resistance, I'm looking to short, I'm looking to buy puts. So these are things that I would keep an eye on. Stephen just mentioned, I haven't seen CNBC do a Sunday night special since COVID, but they've got one tonight. Oh, that's great news. Okay, I'm not kidding at all. Now, obviously, records are meant to be broken. However, where is this data? Let me see if I can find this. So if we take a look at, I've got this great graph. Maybe I'll show it tomorrow during Charts and Coffee, because I'm looking at my images that I usually keep handy. And this is definitely one of them that I like to refer to. And it is the, every time, is it a markets in turmoil special, Stephen? Because if it is, that would be great. But the markets in turmoil special probability of 1 year later, the equity markets are higher is actually 100% since 2002 or something like that. I'll have to go back and find that image, and I will find that image. Oh, here it is. Here it is. This is the S&P, all right, forward total returns following. Now, I don't know what kind of, and this is in no way to mock CNBC. It's a sentiment read, right? Following the CNBC market turmoil special. This is not to say it's calling a bottom. This is simply to say the date the special aired, what was the close in the S&P, and then 1 year forward, what was the return? This goes all the way back to 2010. And since 2010, every time that one of those specials aired, 12 months later, which kind of goes back to what I'm saying, if you're willing to look at the longer term time frame, 12 months later, we're in some sort of forward return, whether that's 21%, 63%. The most recent one on this was May 5, 2022, S&P was at 41.47. And then the markets, so at this point in time, they hadn't quite had the forward return. Everyone knows we've hit all-time highs numerous times throughout 2024. So we know that that was also a very good indicator too. But nonetheless, if that's the case, we're in good shape. It doesn't mean this is the low. It just means 12 months from now, we might see lower lows, but 12 months from now, if that's the case, we're likely to see higher highs. As a trader, we have to compartmentalize. As a trader, we have to remember the stock market is not the economy. As a trader, we have to remember we have different time frames that dictate different time horizons. If I'm looking at a day trade, I might change my sentiment read every 20 to 30 minutes. If I'm on a 1 hour chart, that time horizon is about 1 to 3 days. If I'm looking at a daily time frame, it's 2 to 10 days, maybe to about 3 weeks, right? Shorter expectations for continuation in the direction of my trade. If it's a weekly time frame, now we're talking that 6 months to a year. That's the one that I'm most excited about as far as opportunity goes right now. So be a bear short term, right? Compartmentalize. Don't look at your 401k right now. A lot of people say, I lost money in my portfolio. If you didn't sell, it's an unrealized loss. You don't lose until you close the trade out. And if we're looking at longer time horizons, if this is a longer term account, and I like to call it the touch the money date, if that's still way off in the future, leave it alone. It's only a loss when the trade is closed, right? Okay, so that's what I'm looking at. That's what I'm looking at right now in terms of, yeah, some of the most severe moves we've seen. I do want to make it super clear. This is going to be more of a W or a 1, 2, 3 type bottom, very likely, as opposed to a V or a U when the Federal Reserve typically is the cause for that recovery due to abrupt monetary policy shifts. Again, 2019, 2020. So this is going to be a little bit more drawn out. I'm not presuming we've seen the low, but this is where I'm going to really start fishing. So any symbol that's at that down 20%, now I'm going to start fishing. Now I'm going to start casting my line and looking for those setups, if you will, at this point in the sell-off. So Stephen, yeah, good to know. They're doing one tonight. It's a big open, right? It's a big open. We've clearly gapped down and still kind of seeing some weakness. This is a very illiquid, usually time of the day, although I would imagine there's a lot of trading desks that are quite populated right now. It'll be interesting to see where the volume is relative to regular trading volume, but I don't anticipate tomorrow being pretty at all. There's probably still some lower lows ahead. Let's not call it pain, whatever it is. Let's not go there. Where is the opportunity for traders? And do we care if it's long or short? Yeah, we have preferences. I'd rather be long, but if the setups are to the downside, the setups are to the downside. It is what it is. But the S&P now, looking at the June contract for the futures, is now down just past that 20% pullback. All right. I don't have, as far as MRVL and calls 2 weeks out calls. Oh gosh, I could not even begin to set something up like that quite yet. No, I'm not even allowed, right? So Marco, thank you for the question. See the red candles on the 1 hour, see the red candles on the daily. I'm not even allowed to be in calls because the red candles tell me not only is the price action bearish, the participation is bearish. And by my rules, for me, rules should be something that says, no, not allowed. They should be limitations. A filter is naturally something that takes things out. And for me, those red candles take out the possibility of calls. So thank you for the question. I'm not allowed to. There might be a setup somewhere, but based on my tools and rules, I don't have anything setting up to the long side on a longer term, say 2 week time horizon. It's about tariffs. Oh, bummer, Stephen. I wish it was a markets in turmoil special. We'll see what that does. All right. Next up is, am I looking at the 200 EMA on the weekly? So what I put is something called the top tier dots. And it's really a classic moving average tool where there's a short EMA, usually an 8, and a longer EMA, usually the 200. That's the 200. So this is roughly an 8 200. There's a couple other things in the code, but roughly it's an 8 by 200 EMA. So it's a weekly EMA. I'm not putting a daily on the weekly. I'm using an EMA on the weekly, which means it's measuring the last 200 weekly candles and the last 8 weekly candles. So I don't use a different interval moving average on a different time frame. So no, it's not the daily. It's the weekly EMA. And is that a fishing spot? Yeah, it's a great question. It could be. My first sort of, I'm in the right waters, if we're going to go with the fishing analogy, is, are we down 20%? I mean, if 10% gets my attention in this environment, 20 should really be the jump off point. So I'm kind of jumping in the water, taking a look, or taking my boat out at 20%. Then as far as when I start wanting to get a bite, I need a pattern, I need a level. It might be an inside candle. It might be a minor low. It might be the white dots, which will sometimes be below the 20% in the example of the S&P. It might be a Darvis. There's a lot of, what are the patterns that you like? What are the levels that you like? What are different indicators that you use to confirm that a low might indeed hold, right? Those are really it. I'm going to go to volume probably quite a bit because in '08, when I developed a lot of my volume tools and volume rules, when I really fine-tuned them, I realized that volume is the best, and in many ways, I would say the only way to coattail big money. I don't think big money is smart money, but it is big money. And if I want to coattail what they're doing, you can't be right. I cannot be right in a trade alone, right? The reason a trade works is we get in when we get in, right? And then other people get in, and if it's a long position, they're buying at higher highs. So I know I'm never going to be right alone. That's never the point. So I need to find, do I have some company here? Are there other reasons where there's size that's going to dig their heels in, and I just want to join them, in that zone. So that's the way I would look at that. All right. Do I use volatility indicators in my technical analysis? I do. I use something called the daily and the hourly price movement ranges, which are a historical volatility tool. It's something I created when I wrote my third book. I started really experimenting with historical volatility ranges, which is markedly different than, ATRs and things like that. So price movement ranges say that when you go back 6 months and curate data based on different specifications, sessions and hours, you can start to see different patterns emerge and patterns in price. What's the typical price movement range for a symbol? And that's what I will use. So if you're looking for what that is, and right now we're so far beyond the 68% probability, which is what I optimize for. This indicator has two jobs. One, it's there to tell me what that 68% probability is. But two, it's also there as a reminder to say, Rog, we're way past any kind of normal. This is the Toto, we're not in Kansas anymore moment. And yes, we're way beyond that. And you could see for a lot of the movement up until the third, so not all that long ago. If you go from the end of February to the beginning of April, I mean, it was really very much within those ranges. And then now we're seeing a completely different environment. So when did this begin? Since we got confirmation of what those tariffs are ultimately going to be, we have gone, a lot of people say we've gone berserk. The VIX is up. Yeah, I don't need to look at the VIX. I don't need to look at the SPX options based symbol. I can say normal, 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 normal. Okay, there's my first abnormal on the second. And ever since the second, we've been outside the historical probability. And that's the way I look at volatility. So, and yes, I do. I look at that as another tool on my charts. Absolutely. What would I look for before I begin focusing on buying puts? Really simple, Luch and Jackpot. I'm looking for resistance. I'm looking for candles to rally into resistance. So some sort of relief rally, and then the presumption that the trend will continue. And that's what I'm looking for. So it's the opposite of buy the dip. If for those of you that have been watching the show for a little while, I like to buy support and then get the follow through higher after support or that continuation play. Well, when it's a bearish market, I want to see a rip higher, sell the futures contract or buy a put into that little rally into resistance and then look for the continuation to the downside. So it's just the opposite of buy the dip. If buy the dip is on one side of the coin, sell the rip is on the other. JCW says I typically look for trades I can hold 3 to 5 days. I would continue to be bearish. I'm not allowed to be anything but that. But I want to also remember that this is not a monetary policy driven sell-off. This is not, frankly, this is an exogenous sell-off, right? And so if there is positive news about a delay in tariff, there's positive news about different negotiations happening, those could create relief rallies. And that's the difficulty with the reasoning for the weakness, right? This isn't the Federal Reserve dropping the ball and being able to correct that via messaging and altering monetary policy decisions. This is exogenous, right? This is a completely different type of sell-off than what creates. So this is more along the lines of 2020. That was another exogenous sell-off. 2019 was a monetary policy driven sell-off. 2008 was a different kind of sell-off. 2001 was a tech bubble. So most things are not, interesting enough, this is the second one in 5 years where the sell-off is not going to be as easily fixed, I would remain pretty bearish over the course of 3 to 5 days. And then I just want to remember that we can have quick bursts of optimism based rallies to the upside from time to time. So no, great hypothesis. And I would continue to be, I have to be bearish. I'm not even allowed to do anything else. All right, gang. So with that being said, thank you as always for being here. I'll see you all for charts and coffee. Let's see how this unfolds throughout the Asian session. Europe will open at 2, UK will open at 3. Early volume out of the US will come in around 7, and that's what I'm going to start looking at. Of course, I'll see you for charts and coffee at 9 a.m. tomorrow. All right, gang, be good to each other. I'll talk with you soon.